We're building more rental housing in Canada than ever before. CMHC just dropped this crazy chart that showed how Canada's rental apartment completions just hit a record level, and we're approaching our past records of building rental on a per capita basis. It feels like just a couple of years ago when we were talking about how there was an undersupply of housing, and now all of a sudden we're talking about whether or not there's a potential for oversupply of housing, and specifically rental housing in this context. And for the first time in a generation, the question isn't, will there be enough rentals? It's actually, are we building too many? That's what we're going to be diving into today. And I'll be talking to Chief Economist of Central One Credit Union, Brian Yu, who is probably the most well-researched person on this outside of the CMHC, about his new report that tackles this question head on. So let's start with the data. As you can see on this chart from CMHC's website, Canada used to build a ton of rental housing, as you can see in the 1970s. And basically, as we shifted our policy towards homeownership, that completely dropped off. And we basically went several decades building almost no rental housing. And now we've spent the last couple of years building only rental housing. The majority of these projects come from a mortgage insurance product called CMHC MLI Select. And I've mentioned this a handful of times on the YouTube channel. In fact, 88.4% of the total rental apartment starts come from CMHC issued loan programs. This is government policy doing its job, creating all of the housing that we said we needed so badly, to the point where we're now having a conversation about whether or not we're building too much. Do I love this government policy? Not really, and I'll explain why later in the video, but basically they're super tight numbers. It allows you to get super high leverage and a really low debt service coverage ratio. So there is a bunch of risk that gets created with it. Maybe not risk for the lenders or the insurers, because we know CMHC has a lot of money and the lenders have a lot of money, but risks for the operators and the market itself when you get into an overbuilding situation and everyone's only 10% cash flow positive, and they're only 10% cash flow positive because they're on a 50-year amortization, and their leverage point is 90%. So they're 10x levered into these multifamily assets. And that's becoming a risk now because we're asking ourselves the question, what happens if we oversupply the market? And the answer to the question is pretty clear. Rents fall and vacancy rates rise, which means that the income rents that landlords can make goes down, and time that it takes them to lease a new unit goes up, which means that they're making less money and they're taking on more risk because of this high leverage product and long amortization. This is great for tenants. It means housing affordability from a rental perspective will improve, but it means that it's bad it comes at the expense of landlords, because landlords can make less money and they're taking on more and more risk. So it's a tough time for residential investors and a great time to be a tenant. And I'm actually going to discuss this at length. I've done a video already on how we're entering into a renter's market, not necessarily a buyer's market. And this is one of the best times to be a tenant rather than being a homeowner. And I'm going to do an entire video on rent versus buy in 2025. So hit the subscribe button and the bell to make sure you don't miss that one. The risk factor behind this supply is that many of these projects are financed at high loan to value, low debt service coverage ratio, because CMHC has effectively de-risked them, at least on paper, right? Because the risk is insured away for the lender. But if your pro forma rents don't materialize as an investor right now, so the rents that you forecasted in your application to CMHC, you're in trouble. And CMHC made a couple of moves to try and protect themselves in this regard. Now, new investors who are using these have to have 25% of the project costs in liquid or liquidable assets to protect in case the project is very different on completion than it was on paper on the application. And they've created this rental achievement holdback, which basically they'll reduce the loan size accordingly if you don't achieve your pro forma rent. So if you said your building was going to make $100,000 and your income actually comes in at $80,000, they'll reduce your loan size by that 20% difference, which means that you have to come up with either more equity to put into the deal, or you have to go get a mezzanine or second mortgage to be able to close on that deal. Now, when we look at the risk here, not all markets are equal. And I talked about this in the last one on unsold condo supply, and that was researched by Brian Yu as well. But they did a really good job at analyzing which cities are seeing the highest risk. And the way that they did this is by looking at the ratio of under construction units to the entire rental universe, or all rental units available in the supply in that city. And the highest risk, which you're going to hear Brian talk about in our interview together, is Kelowna. Almost 30% of Kelowna's current rental supply is under construction right now. This means that if Kelowna doesn't see any population growth or new household formation, their vacancy rate will jump up massively. Next on the list at almost 20% is, and then you have Vancouver, Moncton, Halifax, The prairies, there's a little bit of risk as well. You have Calgary, Saskatoon, and then you start going down the list and you get to a lower risk environment, still between 5 and 10% of the rental supply under construction. So again, with no population growth and no new household formation, that's a pure injection to the vacancy rate. So vacancy rate is currently 2. If there's no new tenants joining the market, then that vacancy rate is just going to jump up by that number. Realistically, it's a bit of an oversimplification, but it's pretty close to the truth. And you can see this pretty clearly in Brian Yu's analysis, where it shows the rental market supply ratio versus the vacancy rate and the correlation between that. One more thing I'm going to add before we jump over to the interview with Brian Yu. This whole rental thing, this shift that we're seeing in Canada, and you can see it really clearly in the chart in Brian Yu's analysis here, which shows that CMHC rental market construction is hitting a record high and rental market share of total construction. So of every single hammer that's being swung right now, rental market construction is at a record high of our total construction world right now. A lot of this plays into that whole World Economic Forum, you'll own nothing and be happy thing. And I don't necessarily see this as a bad thing. I don't think that there's anything inherently wrong with renting. And I think in a lot of cases, people associate owning property with freedom, but I actually think it's comparably less freedom. You have to pay property tax, you have to pay land transfer tax. If you need to move, you have to now sell your asset, which takes time. We're in a liquid market right now. You also accrue switching costs. And if you don't pay your income tax, they CRA or IRS or whoever it is has an asset that they can lien. So you're actually buying more into the idea of a state or the government than if you're renting, where you really just have obligations to one entity, which is a subscription model on paying a landlord. And if you want to move, you give them notice and you leave. Banks actually have an easier time evicting people for non-payment than landlords do in most jurisdictions in Canada. But in Canada, we've built this cultural obsession with homeownership. And historically, the reason for that is Canadians suck at saving money and we suck at investing. And so homeownership does a really good job at doing those things for us. And ironically, people say if they're anti-landlord and they don't like this rentier economy idea, if you're anti-landlord, then are you not pro-tenant? More rental supply is pro-tenant. And we're seeing that now with rents falling and higher vacancy, which means more options for tenants. So that brings us to my conversation with Brian Yu, chief economist at Central One Credit Union and the author of this excellent economic commentary on Canada's rental market. We're going to dive into which markets are most at risk of oversupply, how fast this new supply is going to hit, what falling rents could mean for investors and for tenants, and whether or not CMHC is fueling a boom that could turn into a bust. Thanks a lot for watching so far. Make sure you hit the subscribe button. Leave me a comment. I'd love to hear your feedback on all of this data and my interview with Brian. And I'll see you again within the next week.
So Brian Yu, I'm chief economist at Central One. I'm out here in beautiful Vancouver, so it's always nice to be able to chat. We do a lot of analysis around the housing markets, but macro and regional analysis for credit unions across our BC, Ontario markets, but also across Canada.
Your latest research, I know I'd recently done a video on my YouTube about the last report that you put out, which was unsold condo inventory. Any key findings from that one that really stood out to you in the analysis that you did in that regard?
Yeah, we've done a couple of reports here, whether it's the unsold inventory. Those are a lot of CMHC data. So we're looking at what hasn't been pre-sold or what has still in the market after completion. We've seen obviously some rising numbers across markets as of the last year. Toronto's a weird outlier just because CMHC seems to be understating it. But I think a lot of it just has to do with a lot more units being fully sold out and making it into the inventory of the resale market rather than being stuck in that unabsorbed market. There's a lot of challenges right now just around the overall housing market, whether it's on the unsold inventory side or what we're seeing is this kind of a wave of what we think is a rental supply coming on stream, just as potentially the outcome of the positive that we're building a lot when we needed it, but also some of the weaker demand environment that we're seeing.
Let's zoom in on that a little bit, because I felt like there are two converging risk forces happening in the Canadian housing market right now. One is obviously what we just discussed, which is there's a lot of unsold inventory and even a lot of inventory that was maybe overpaid for hitting the market and kind of getting into the resale side of things. And there's some losses being realized in that regard, as well as losses being realized over time from people being cash flow negative. But now you're also seeing basically your pre-construction pipeline has almost completely fallen off, but there's still huge demand for housing. And a lot of that pre-construction housing that would have been built is now being backfilled by purpose-built rental construction. And you, I think, documented better than anybody that I've seen, and I'll share the screen while you're speaking about it, just how substantial of an impact this is as a percentage of the total construction that we're seeing right now, as a percentage of the total units. What is happening in this rental space right now? Like how much is coming online and why?
Yeah, so I think it's really interesting just in terms of that rental supply aspect because we've come for the last few years, everybody's been talking about how much undersupply of rentals we've been seeing, obviously very low vacancy rates, a reflection of that high demand, and also some of the lack of construction in prior years for rental. But I think we've done a great job in terms of the market demand, whether it's public sector, whether it's private sector, all pushing that need for rental product, and we've seen that shifting over time. About we look at current under construction, about 45% of, I think 45 to 50% of metro markets are essentially rental construction right now. Is it all purpose built? It's intended markets. So some of them might be privately owned suites or whatever the case may be. But again, a big chunk of this is now that rental, potential rental supply in the market. And, not all markets are going to be the same. I think that when we look at where is this rental supply seemingly greatest, there's definitely some markets where, like Vancouver, I think, in Barrie, for example, and Kelowna especially, where the number of units that are currently under construction right now, it's pretty substantial. In Kelowna, I think that number is closer to 30% relative to the purpose-built stock that's currently being built out. So if those units come to market, you can imagine that we're likely to see a pretty substantial increase in vacancy rates. As a result, we're going to see some of that demand fall off. And again, that reflection of that, it takes a long time to build up product, number one. So everybody has been shifting gears as the home ownership market has slowed a lot, very few pre-sales, shifting to the rental markets. But at this point, because we have fewer students, fewer temporary residents, and likelihood that population growth is probably sitting near zero in over the next couple of years, it does point to this ongoing softening of the rental market. And it's not a bad thing. I think people have faced very high rentals rates over the last few years. So for many cases, for many people, this is a good thing.
Yeah, I think that that's the thing that a lot of people miss, right? Like it's really easy to talk about this as a bad thing because if we're serving the clientele of maybe the investor who obviously wants rental rates to continue growing so their net operating income grows, or they want lower vacancy rate. But by and large, this is the outcome that policymakers intended and that the market was asking for when we asked for more supply, and now we're finally seeing it happen. So I guess if vacancies continue to rise, like it should be reasonable to estimate that rents could continue to fall for the foreseeable future without more household formation or population growth.
I definitely think we're going to see that downside pressure in terms of overall in some rents now. I think that when we think about landlords and we think about building owners, they're really loath to cut rent. It's because you're repricing all of your units at that point. So I think what we will see, and we have seen in past cycles, is there's going to be a lot more incentives. How many months of rent for free is someone willing to give? What type of amenities are they willing to provide as well? So there's going to be a combination of this. But I think we've also seen in the past that there's that developers who are building rentals right now, they're not necessarily stagnant. That's a dynamic market. That if conditions start to worsen significantly more, we see some of these buildings that are under construction being repurposed back into the condo sector as well. Whether they can do that under zoning or city rules, that's another question. But I think there'll be a push towards some of that condo conversion into the condo market as we do expect that, given the lack of building that's going to be occurring in the condominium apartments market, there is going to be a shift in that demand going forward.
Yeah, I guess that agile supply is probably the way where somebody has like multiple potential exits. If they condominiumize a project on the forefront, but then plan to terminate it as a rental and rent out all of those individual condo units, they still potentially, like they'd obviously have to pay a cancellation fee or a break fee to get out of their CMHC loan, but they could eventually trickle those units out or sell them off maybe as they become vacant or whatever. So you almost have two potential outcomes for the supply that you're putting in the market. I never really thought about that.
It'll be an adjustment, I think. I think that's the key, right? It's not, I think on net, you will see those vacancy rates rise. We're going to see softening rents and declining rents. And again, this comes after some massive gains during the post-pandemic period. So this is probably healthy. I think nobody, at least I'm in Vancouver, when we're talking that people are paying $3,000 to $4,000 in rent, these are pretty substantial numbers relative to income as well. So getting that back to hopefully something more stable, it would be a good thing for the market.
And so a lot of these developers who are building this, they probably were contemplating these projects maybe 2 years ago when vacancies were 2% and rents were rising. And now we're in an environment that's different. Vacancies are rising and rents are falling. Are you anticipating or sensing that we're going to start seeing some of these rental developers maybe slow down their pipelines a little bit, or does it still seem like a full steam ahead kind of thing?
I think they will. I think they're going to adapt to the market. There are other considerations, I think, for the rental market in that policy-driven outcomes should be discounted. I think there's still going to be a lot of policy to drive rental construction, even though we are in this period in which there seemingly is excess supply coming to rental market, also excess supply in the existing home market. We probably want to look at that in terms of that longer term trend. There's still a substantial housing shortage in in Canada overall, whether really across the country. So we still need a lot of units to be built, and I don't think there's going to be necessarily a shift in policy to limit some of this growth. I think there's still going to be a need and a want to drive more construction over the longer. But again, we are seeing some adjustments, whether it's in that ownership market or rental market, that's probably going to lead to, at least a short term, that undersupply of housing in the next couple of years.
Yeah, very interesting. Is there anything else that I didn't cover from your report that stood out to you that you wanted to mention?
Yeah, I think partly, at least, what we want to note is that every market's going to be quite different here. Not all of them are going to be oversupplied. That when we look at units that are being currently built relative to their stock, there's a lot of metro markets where these numbers are quite low. It's not going to have a discernible impact on their vacancy rates versus in areas, I think, on top here around some of the Atlantic provinces, as well as Kelowna, which again have been geared towards either providing more housing for newcomers, temporary residents, students, and the like. And that has, of course, dissipated over and will continue to ease off for the next couple of years, while some of the, I think, more affordable markets are still, they haven't really overbuilt even in the current context.
So for like real estate investors or maybe even tenants planning their future, they should be paying attention to some of these markets where you might actually see compression in rents. For investors, obviously, they might want to be avoiding some of those markets that appear to be oversupplied. For tenants, maybe making future plans, seeking more affordable housing, they might actually be wanting to move to some of those markets where it looks like rents could compress for the foreseeable future.
Yeah, and it's going to depend on the market because we're obviously in a very strange economic situation. Some of these markets, which are losing students as well, or losing, could also be facing other challenges, whether it's tariff related or high levels of unemployment in these areas as well. So it's going to be quite a challenge for an investor. Your international immigration numbers are still going to be filtering into the larger markets. I think we have to remember that's likely the case, that the large urban markets still gain the most people over time, and those are likely still going to see long-term pretty low unemployment rate. It's really those segments I think segments where you have a lot of building, but also relatively limited economic benefits going forward, or the economic growth going forward.
Yeah. Yeah. Awesome. Brian, I really appreciate your insight. Honestly, I was really happy to have this conversation. If anybody wants to reach out to you, learn more about your research, et cetera, like where do you want them to connect with you? Is LinkedIn the best place, or email? Or...
Yeah, absolutely. You can LinkedIn, but you can go to central1.com. We publish most of our economic materials on our site there as well.
Okay. Amazing. Thanks again. Really appreciate your time. And I would encourage anybody to go check out your research. I spend a lot of time looking at it, and I find that you have some of the greatest insights in the market right now. And honestly, just an honor to have you on the show. So thanks.
Thanks very much.